The US dollar has been on a tear in 2022. As of the beginning of October, it is up 20% against the Japanese yen, 16% against the British pound, 10% against the Aussie dollar, 7% against the Canadian loonie, and even 5% against the Singapore dollar. Against cryptocurrencies, the King dollar's gains have been even more spectacular, with Bitcoin dropping 56% against the greenback so far this year. The surging dollar is wreaking havoc in many parts of the world, especially the poor ones, by pushing up borrowing costs and reducing the purchasing power for dollar-denominated everyday commodities like oil and wheat. Countries from India to Japan to the Czech Republic have been forced to resort to currency interventions to stem the surging dollar. Indeed, the world central banks have already spent $1 trillion of their foreign reserves in defense of their currencies this year. Why is the dollar so strong? What does it tell us about the political and economic realities in the world today? What does it mean for your money? Is it too late to jump on the buy the dollar bandwagon? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you will be notified when a new video comes out. An important measure of the dollar's strength is the Federal Reserve's trade-weighted real broad dollar index. The index is calculated as an average of the foreign exchange value of the US dollar against the currencies of a broad group of major US trading partners, weighted by the size of their trade with the US and adjusted for inflation. According to this measure, the dollar is at a 40-year high. The last time the dollar was this strong was at the beginning of the 21st century, when the US was at the pinnacle of its political and economic power. At the time, the Soviet Union had already collapsed, and China was only at the beginning of its explosive growth path. And of course, the US had not yet invaded Iraq. Economically, the IT revolution that began in the US was giving a big boost to US productivity growth, and the US government was running a fiscal surplus for the first time in decades. In other words, the US dollar was strong because the US was the envy of the world. Everyone wanted to buy US assets. The US is certainly not in that enviable position anymore. One important reason, if not the most important, is the, of course, Russia-Ukraine war. Well, more specifically, the US-led sanctions against Russia. To see this, let's take a look at the monthly US trade balance, which measures what the US exports versus what it imports. What it shows is that following a massive deterioration in the second half of 2021 and the beginning of 2022, the US trade balance has improved dramatically since the sanctions kicked in. Why? A key driver has been a big jump in US exports of industrial supplies and materials. Indeed, in the first 8 months of 2022, total US exports of industrial supplies and materials came to a whopping $558 billion, which is about $200 billion more than the average for the first 8 months of the past 10 years. So what exactly are these industrial supplies and materials that the US is exporting more of? Well, crude oil, fuel oil, natural gas, coal, fertilizer, aluminum, iron ore and steel, and other non-ferrous metals. In case you're wondering, these things happen to make up the bulk of Russian exports that have been adversely affected by the US-led sanctions. Another interesting fact is that while the US trade balance has improved markedly since the start of the war, the trade balance of key US allies that have signed up to the US sanctions against Russia have deteriorated in a dramatic fashion. Indeed, the combined trade balance of US allies in the Americas, Asia, and Europe have gone from a surplus to a deficit this year, with Canada and Australia the only ones that still run a trade surplus. Never in the past 20 years has the combined trade balance of key US allies been worse than it is now. You won't hear this from Washington, but it would appear that the biggest casualties of the US-led sanctions against Russia are, yes, US allies. The sanctions have turned these countries as a group from creditor nations to debtor nations. The sanctions might have reduced the dependence of US allies in Europe and Asia on Russia, but at the same time increased their dependence on the US. You don't have to be a currency strategist to see that the massive turnaround of the U.S. trading position against its allies is the main reason why the U.S. dollar has been so strong against the currencies of these countries. This turnaround in the relative trading position between the U.S. and its commodity importing allies, which also reflects the fact that Russia is a much more important market for some of these U.S. allies than it is for the U.S., is also an important reason behind the relative resilience of the U.S. economy this year. Increased export demand has helped support U.S. industrial production, while negative terms of trade shocks associated with the massive spike in energy prices are acting as a drag on economic activities in countries in Europe and Asia. The most recent Purchasing Manager survey reinforced this point. We need to remember that the foreign exchange market is a relative value market, where a currency goes up only because another one is going down. The Russia-Ukraine war brought about a global price shock that is forcing central banks around the world to raise interest rates more quickly than what they would have done otherwise. The fact that the U.S. economy is faring better from the shock than the economies of the main U.S. allies means the U.S. economy can withstand higher interest rates than those of other economies. U.S. interest rates have been rising more quickly than anywhere else. This has sapped foreign demand for U.S. stocks. Indeed, foreigners have sold nearly $300 billion of U.S. stocks through July this year. However, this has boosted foreign demand for U.S. bonds, with foreigners buying $700 billion of U.S. government agency and corporate bonds through July. The net capital inflows into the U.S. were just shy of $1 trillion through July. The bottom line, the U.S.-led sanctions against Russia boosted the demand for U.S. assets and drove the dollar to its 40-year high. If my analysis above is correct, then the answer to this question will depend importantly on how long the war and the sanctions drag on. A long war will clearly benefit the dollar, while a short war and relaxation of sanctions will likely see the dollar fall. The decision by Putin to annex the 4 regions of Ukraine that are mostly under Russian control and to mobilize more than 300,000 troops is a clear sign that Russia is preparing for a long war. All else being equal, this should be viewed as dollar positive. In response to Putin's annexation, Elon Musk this week proposed a peace solution that would involve Ukraine agreeing not to join NATO. This plan was immediately rejected by the Ukrainian government. Zelensky's defiance should be viewed as dollar neutral, though, as Ukraine is the last player around the table that will determine how long this war will last. This is because if it weren't for the massive amount of money and weapons it receives from the US and Europe, it would have lost the war long ago. Ultimately, only the US and Europe will decide how long this war will go on. Given that the Biden administration is unlikely to finance Ukraine's war effort alone, and given the war and the sanctions are worse for Europe than they are for the US, it is reasonable to think that it will be up to Europe ultimately to decide on its duration. For currency investors, there's no doubt that European policymakers hold the key to the outlook for the US dollar. Over the past month, the mood in Europe towards the war is changing. The united front between the US and Europe at the start of the war seems to be fraying around the edges, if not fracturing. President Macron recently went as far as calling on France to project itself as a balancing power and to not align itself with more hawkish countries, which will risk extending the conflict. More recently, Germany's staunchly anti-Russia economy minister accused the US and other friendly gas supplier states of astronomical prices for their supplies, suggesting that they were profiting from the fallout from the war in Ukraine. All throughout September, there were major demonstrations across Europe, including in Germany, demanding an end to the energy embargo against Russia as the public wakes up to the grim economic reality facing the European continent. Meanwhile, there are unconfirmed reports that the hard-hit German industries began lobbying the German government to help bring an end to the war. These developments might have helped bring the warring parties to the negotiating table if it weren't for the sabotage of the Nord Stream 1 and 2 pipelines on September 29th. These developments might have helped bring the warring parties to the negotiating table if it weren't for the sabotage of the Nord Stream 1 and 2 pipelines on September 29th. It is impossible to know for sure which party blew up the pipelines. However, it is clear that the US has the most incentive as well as the ability to do so. This is because blowing up the pipelines reduces the incentive for Europe to negotiate with Russia. It cements the dependency of Europe on imported gas from the US. Whether Biden ordered the sabotage of the Nord Stream pipelines or not, it is clear that the US has much to gain from it, and that the US dollar could be the big winner long term. In the short term, as more Russian troops pour into the battlefields in the coming weeks, the war in Ukraine will likely intensify and grow uglier. With the decision of OPEC and Russia this week to reduce oil production by 2 million barrels a day, energy prices could ramp up easily. This coming winter will push Europe, the United States' most important ally, to the edge of the precipice. The tragedy is that the case for US dollar bulls requires the Europeans to continue to commit economic suicide. By contrast, for the dollar bears to be right, only requires Europeans to open their eyes to their folly. Which case will win out in the end? I don't know. But I do know that in the 6 weeks between now and the US midterm elections, the Biden people will do whatever it takes to ensure that the Europeans fall in line with US policies. This means the dollar rally and possibly the equity correction too have at least 6 more weeks to go. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come check us out at davidwunbound.com. Thank you for listening.